Financial statements become significantly more informative when analyzed using accounting ratios and trend analysis. Ratio analysis enables investors, lenders, management, regulators, and other stakeholders to evaluate profitability, liquidity, efficiency, solvency, and market performance by transforming accounting data into meaningful performance indicators. However, individual ratios should never be interpreted in isolation. Effective financial analysis requires comparison with prior years, competing entities, and industry benchmarks while considering the entity's operating environment, accounting policies, and strategic objectives. Consequently, ratio analysis provides a comprehensive framework for assessing financial performance and position while supporting informed economic decision-making. Definition and computation of financial ratios. Financial ratios express relationships between financial statement items and provide standardized measures for evaluating business performance. Profitability ratios. Profitability ratios measure the entity's ability to generate earnings from its resources. Gross profit margin. This ratio measures production and pricing efficiency before operating expenses. Operating profit margin. It evaluates operational performance excluding financing and taxation effects. Return on capital employed, ROCE. ROCE measures management's effectiveness in generating returns from long-term investment. Liquidity ratios. Liquidity ratios assess short-term financial stability and ability to meet current obligations. Current ratio quick, acid test, ratio. The quick ratio excludes inventories because they may not be readily convertible into cash. Efficiency ratios. Efficiency ratios evaluate how effectively assets are utilized. Inventory holding period, trade receivable collection period, trade payable payment period, asset turnover ratio. These measures assess working capital management and operational efficiency. Gearing ratios. Gearing ratios evaluate financial risk arising from long-term financing. Common measures include debt-to-equity ratio, debt ratio, and interest cover ratio. Higher gearing generally indicates greater financial risk but may enhance shareholder returns through financial leverage. Performance aspects measured by ratios. Each ratio focuses on a distinct aspect of financial performance. Profitability ratios assess management's ability to generate earnings from sales and invested capital. Strong profitability indicates competitive advantage, efficient operations, and sustainable value creation. Liquidity ratios evaluate the entity's capacity to meet short-term obligations as they fall due. Weak liquidity may indicate cash flow difficulties despite reported profitability. Efficiency ratios measure how effectively management utilizes assets and working capital. Slow inventory turnover or extended receivable collection periods may indicate operational inefficiencies or credit management weaknesses. Gearing ratios assess long-term financial structure and exposure to borrowing risk. Excessive debt increases financial risk and vulnerability to rising interest rates, while moderate leverage may improve shareholder returns. No single ratio provides a complete assessment. Meaningful analysis requires consideration of multiple ratios simultaneously. Trend analysis using previous financial statements. One of the most valuable applications of ratio analysis is comparison with previous accounting periods. Trend analysis identifies improvements or deterioration in profitability, liquidity, efficiency, and financial stability over time. For example, rising gross profit margins may indicate improved pricing power or production efficiency. Declining operating margins may suggest increasing administrative costs. Falling inventory turnover may signal declining demand or inventory obsolescence. Increasing gearing may indicate greater dependence upon external financing. Trend analysis enables analysts to distinguish temporary fluctuations from long-term structural changes affecting business performance. However, historical comparison should consider inflation, acquisitions, changes in accounting policies, restructuring activities, and unusual one-off transactions that may distort comparability between reporting periods. Comparison with similar entities. Ratio analysis becomes more meaningful when comparing an entity with competitors operating within the same industry. Cross-sectional comparison enables investors to identify relative strengths and weaknesses regarding profitability, operational efficiency, liquidity management, and capital structure. For example, a company reporting an operating profit margin of 15% may initially appear successful. However, if comparable competitors consistently achieve margins exceeding 20%, management performance may actually be relatively weak. Similarly, Differences in inventory turnover or receivable collection periods may reveal operational advantages or competitive disadvantages. Meaningful comparison requires entities with similar business models, accounting policies, risk characteristics, and operating environments. Comparison with industry average ratios. Industry average ratios provide another important benchmark for evaluating financial performance. Industry averages reflect normal operating conditions and expected financial characteristics for businesses operating within a particular sector. Comparison with industry benchmarks enables analysts to identify whether performance exceeds or falls below normal industry standards. For example, higher ROAS than industry average may indicate superior management efficiency. Lower liquidity ratios than competitors may suggest financing difficulties. Excessive gearing compared with industry norms may expose the entity to increased financial risk. Superior asset turnover may indicate more efficient utilization of productive resources. Nevertheless, industry averages should be interpreted cautiously because companies may differ significantly in size, strategy, geographical operations, product mix, or market positioning. Limitations of ratio interpretation. Although ratio analysis provides valuable insights, it possesses important limitations. Different accounting policies, depreciation methods, inventory valuation techniques, and fair value measurements may reduce comparability between entities. Inflation may distort historical cost accounting, particularly for non-current assets acquired many years earlier. Seasonal businesses may report year-end balances unrepresentative of average trading conditions throughout the year. Furthermore, ratios are based on historical financial statements and therefore cannot fully predict future performance or reflect qualitative factors such as management quality, technological innovation, sustainability risks, or competitive strategy. Consequently, financial ratios should be integrated with broader strategic, economic, and industry analysis. Financial reporting significance. Ratio analysis transforms accounting information into meaningful performance indicators that support investment, lending, and management decisions. By calculating profitability, liquidity, efficiency, and gearing ratios and comparing them with previous periods, competing entities, and industry averages, users gain valuable insights into an entity's financial strengths and weaknesses. Nevertheless, informed interpretation requires professional judgment and consideration of accounting limitations, business circumstances, and external economic conditions. Used appropriately, ratio analysis remains one of the most powerful techniques for evaluating the financial performance and financial position of both single entities and corporate groups under IFRS financial reporting.